the company was very early on in sort of really understanding virality and growth. And, I think Reid and I learned a lot just by watching these guys, because they were genius and insidious. Like it was crazy, some of the shit that they were coming up with. And I will remember this really incredible memory that I had where Reid and I were in Park City for Dialogue. And this would have been, Reid, you'll know the date, I don't know. I'm guessing it was 2009 or 10. And he was doing the Series A investment in Airbnb. And he was in the parking lot. We were in the parking lot just walking around. And he basically let me tag along with him while he was on the phone, because it was in the midst of we were just hanging out and talking. And, my only memory at the time was, oh, that's kind of a funny name, Airbnb. What does that mean? And then also thinking, this idea will never work. Reid's crazy. And it turns out both were completely wrong. And, A, he's a genius, and B, obviously it's an enormous business. But I've known you now for 15 years, I think.
Yeah, exactly. I left my walker around the corner. So I want to remind everyone as we get in now to other questions, we'll take a bunch of audience questions, so you can post your questions in the Q&A tab. I might even call on a couple of you to come on stage on camera. If you can compete with Chamath's video quality, it's already received wide praise in the chat, Chamath, so hats off on your setup. But the audience, as everyone knows here, everyone in this meeting are angel investors, early stage founders or executives who are doing angel investing, and we're all really intrigued by the future of venture capital. There's a bunch of innovation happening, and both of you are on the record with both words and dollars arguing that venture needs to evolve. Reid, in addition to being a Greylock, a GP at Greylock, you're also a significant LP in a bunch of these new disruptive venture capital strategies. Village Global, of course, with our Luminary Network and Scout Network, Sweat Equity, which delivers talent services for equity, Entrepreneurs First, which co-founds companies coming to academia. And Chamath, you famously, of course, have moved away from a traditional venture capital firm. You've called venture firms multivariate Ponzi schemes, and are now helping revitalize SPACs. So Chamath, maybe you can go first. What do you think is broken about venture today, and what are your ideas about how to fix it? And then Reid, why are you backing a handful of these new experiments that are trying to do venture differently?
I think both of us probably feel the same thing, which is that when we were first in the Valley, going back to the year 2000, even earlier for Reid, the first generation of venture capitalists you'd meet were all operators. And they had all been founder entrepreneurs in some way. And so they were very sympathetic to the journey of the entrepreneur. And I think that what happens somewhere along the way is what happens in success to a lot of people, which is that they become risk averse. And I think that these early venture capitalists, when they had some success, scaled by adding people who themselves were talented, but had a very different concept of what they were doing. And they viewed themselves as managing risk. And so it became a relatively predictable group of people. And they were essentially minimizing looking bad. And so, whenever a cohort of reasonably smart people want to not look bad, they just copy each other. And so you end up getting a bunch of lemming-like bad investment decisions over waves. And that's sort of what frustrated me. And it was basically impossible to swim upstream from that, because it doesn't really matter how, excited you could be about a certain thing. If other people aren't invested in that idea and want to help support that thing, you basically die on the vine. And I think that's what's made, for me, venture problematic. And so then when you double click into that problem and you look inside of most venture firms, you see fewer and fewer people who've actually built things, and you see more and more people who look and behave and act like a risk manager. And so it just becomes a very non-exciting place. And so then the most dangerous thing happens, which is then the entrepreneurs, who themselves are very scrappy, start to morph themselves and change their language and their behavior and their ideas to match what will get accepted, because there's an impedance mismatch with the capital and what's acceptable. And then the people themselves inside those firms and double click on that, and they say, wow, like it's much easier to just have all these other guys who look like me believe in what I believe, mark up the deal, I'll raise a new fund, I'll generate more fees, and now you go 4 or 5 funds without ever returning capital. It's nuts. It makes no sense. It was impossible for me to find a like-minded group of people that I could work with at the early stages who were like that. And at the same time, I thought that there was more opportunity in the later stage. So, I think that venture will go through a renaissance at some point again, but it needs people like, I think, Reid and myself, frankly, to win, and it needs traditionalists to lose.
So, and Chamath and I, unsurprisingly, agree on the fact of company building versus, I don't think I would put it as risk manager as much because there's this risk question, but banker, right? Like it's not just capital or kind of stock picker, but a person who, has built stuff before, knows how to partner in doing it. Because sometimes people who build stuff before actually, in fact, don't know how to partner well in doing it. They're, great athletes themselves, not such great coaches or partners. So, you have to look for that kind of combination. But the thing that I think that I would also being driven by, in addition to let's make this be company builders, is Silicon Valley and then I think other ecosystems are moving from kind of a pure cottage industry to something more of an industry, and so different rules start applying because you start having like for example, how do you reinvent thinking networks, right? That's part of the reason why the Village Global, it's kind of like having a whole bunch of network leaders. It's part of the reason why I think about entrepreneurs first, which is, all right, so, like how do we say we recruit entrepreneurial engineers? We put them in a place where they're fundamentally matchmaking. They still generate their own ideas, but how do you get kind of more interesting deep tech? Another one in Silicon Valley here is sweat equity, which is, how do you have the best engineering recruiting services tied into these early stage companies in order to make them work? And so you start thinking about this as kind of reinvention at a kind of at a network level, and thinking about now it's not just the cottage industry, but actually in Silicon Valley is a complete network, and then operating the network. And and I think another thing where I would we kind of maybe different lenses into some critiques of quote unquote traditional VC is to be thinking about it isn't you have to be operating in networks, and that's how I think part of the reason why like modern VCs try to say, hey, how do I have good recruiting services, good customer acquisition services, other kinds of things in order to really do that. But I think the groupthink, I think, becomes endemic. And I think, part of the opportunity that is presented when you get groupthink within a class is you get to kind of break left or break right. And, one of the things that I, always appreciated about Chamath and small number of other people is like, okay, how do you think, like, if everyone's going down path A, how do you think about path B, as an example?
So Chamath, what's your prediction in terms of the early stage venture as an asset class? You said
it's trash. Just in terms of returns, it's terrible. You basically are signing up for what is now 13-year illiquidity, and you're paying, basically like 300 to 400. You're paying 300 to 400 basis points of risk premium. What does that mean? If the public markets can give you 15, 16% a year, the typical venture fund returns 12 or 13%. So it returns less. So why would you have your money locked up for 13 years where you can't touch it to make 200 or 300 basis points less in the public market, which is infinitely liquid? It's a hard proposition. So I think the question more is, so then where does it go? And I think it's going to very different sources that I think are quite inspiring to me. So one is all of the sort of startup studios and the incubators. I think that those are wonderful. And the reason that those are wonderful is that they give people a chance to coalesce in a very safe space around ideas, and they decouple this idea that you need a whole bunch of capital to start with. Really, you don't. You just need a willingness to sort of bank around a concept and not have the intellectual persuasion to go to something easier. And at the earliest phases, I think like incubators will separate themselves in their ability to do that. And I think, like, for example, even if you look at YC, like YC's was a puppy mill for a while, and now they've gotten back to a really legitimate form of company starting, which I think is much more ambitious and exciting, and they have these vertical tracks. That's one. And then the second thing to me that's really exciting is the emergence of these individual angels, super angels, solo GPs, and the mechanisms in AngelList to make them functional. Because then again, you decouple and you break the groupthink dynamic. And, folks, again, like you saw this in the election, like the ability for people to basically, preference falsify at the highest order is incredible. But when they're in the voting booth by themselves and they have to answer to no one, they're like Trump. Great. But you're better off in a place where you felt like you could just say that. And I think similarly, solo GPs are in this world where they can just vote with their dollars and not have to justify it to anybody. And so I think what happens is you have a broad distribution of outcomes. There is where you'll find alpha. And I think that's what we have to do. And then the second thing is we need to move the window of liquidity in, because you can't have these companies hanging around long in the tooth for 13 years. It doesn't make sense. That's not an institutional asset class that works at scale. And so this is what Reid is doing, what he and Mark are doing, what I'm doing with IPO 2.0, I think are really good too. So those three things give me hope that the asset class can be more productive.
Well, and that's certainly aligned with our views at Village, of course, and a lot of the people on this call are the solo capitalists, micro fund managers, angels, people running studios, incubators. So I think all of these experiments are super exciting. Chamath, you've said the word risk a couple times already in this conversation, and you've said that one of your biggest strengths is assessing risk. And Reid, you as well have talked a ton about taking intelligent risk and as one of your superpowers. So I'd love to hear both of you opine on this. Chamath, how have you gotten better at thinking about risk over your career? Is there an example of a risk you've taken recently or not so recently that you think has benefited from this evolved judgment? And what advice would you give to the angels and investors on this call about how to be better at understanding risk? And then Reid, same to you.
I'll give you my answer as it is today, which is that I think that there is a continuum of risk. And on one end of the spectrum is what I would call small quantums of capital. And you can define what that means for yourself. And then on the other end are large quantums of capital. Over here, in small quantums of capital, my risk tolerance is prone to action. I don't like to think about things too much. I think that it's much more about optionality and the positive optionality of being able to see if something works. And a lot of the times, the things that you bet on that you expect to succeed don't. The things you bet on and think marginally can. So there's just a bunch of unpredictability. So for me, I still do a reasonable amount of angel investing and early stage investing, but purely off of my own balance sheet. I'll get an email randomly in an inbox. I kind of like it. I don't think at all about it. The guy wants $1 million, $2 million, 500,000. I'll just send it to my team. I'll be like, just wire her the cash and let's just see. So there, it's all action. Get 100 bets a year on the field and just see. And then, when I'm writing quantums for me, which are sort of 250, 500 million and up, it's all about inaction. And I try to create enormous amounts of time where I don't make the decision. And that allows me to get to the level of thinking that I need to be right. Because over here, it doesn't matter that I'm right or wrong, I'm learning. But over here, I need to be right, because this is where you go out of business. There's the going out of business risk. If I write 3 or 4 bad checks at 500 million each, I burn through $2 billion. For me, that's a lot of money. So it's tough. So, in the last, for example, since the financial crisis, since the coronavirus pandemic really started, I've written 500 million of pipes, and then now, another 250 odd million of these SPACs. And it's taken me a long time, but I've gotten really good at just going deep into the process, immersing myself. I don't respond to any emails. I don't listen to anybody. I come to my office, I lock myself in, and I'm just here. I'll be randomly wasting time listening to podcasts, reading, but I'm always just thinking and letting it marinate. I get to an answer. But over here, it's just constantly firing. 50,000, 100,000, 500,000. I don't think twice, and I let it bake.
So I think the parameter of capital, obviously, and kind of risk assessment is a very good one. I tend to look at these kind of questions of how do you know that you're taking an intelligent risk? Because risk is one of the things where if you're handling it well, it can be a huge differentiator in returns, in success, etc. And so part of it is you think, okay, well, what are the kind of mechanisms? Well, one of the ones that I most like is when you take kind of contrarian risks and are right. Now, that's the hard part, of course. And so what you do is you say, okay, why would smart people not think this is a good deal? And what do I know that they don't know? And I think this kind of lends a question for how you take intelligent risks, because you say, okay, what are the real risks in this? And then why do I have a theory that the risk that we can navigate that risk? The risk may not blow up. Like, for example, Chamath was mentioning Airbnb. This has kind of one of the funny storied kind of Greylock investment things, because when we were discussing at the partnership table, David Z, who I love, part of the reason I'm at Greylock, looked at me and said, "Hey, every venture capitalist has to have a deal they're gonna fail on. Airbnb can be yours." Very similar to Chamath's reaction. Now, part of the thing I love about David is he came back to me 6 months later, numbers hadn't changed, said, "I was wrong, you were right. What did you see?" And I said, "Well, look, you were right about the fact that there could be some horrific event that quelled the growth. There could be regulatory, et cetera, et cetera. But if it didn't play out, if those risks didn't play and they weren't necessarily going to play, then you have something huge." And that's when you kind of look at this as a whole portfolio. So part of being
and Reid, can I just jump in? One of the things that I think you're really interested in with respect to risk is how you take risk on people. And many of the angels in this event are making founder bets fundamentally. It's day zero. It's a guy in a gal in a garage. And you have this incredible superpower of being able to not let certain flaws overly cloud your judgment. People can be flawed and still be backable. People can have weaknesses and still have unbelievable strengths, and you can see those strengths, at least in my experience. How do you think about risk as it relates to betting on founders or betting on colleagues or team members?
So the risks you take and the risks you shouldn't take. For example, a risk you shouldn't take is if you think the person is kind of like ethically challenged or deceptive. It doesn't understand like fundamentally partnering with you. It's one of the reasons the piece of advice I give to entrepreneurs is present the risks that you see in the business so you can start working on them and have a genuine partnership in doing it. Those kinds of risks, once you get there, you're like done. Right? You just can't navigate any of the rest of it. Good luck, we're out. The kinds of risks you should take are, for example, classically is, you should only invest in people who started coding before they were 12. Well, then you wouldn't invest in Brian Chesky. There's heuristics. Like if they started coding before they were 12, there's interesting characteristics that are likely to be there. That's useful. Mostly you kind of look at, are they learners and are they willing to also work with other people? So, because no one is all strengths, right? Anyone who's like, oh yeah, they're all great at everything, that's a huge mistake. And if you get that, then you can look at what are the risks you might be taking with this person. And the most often one that I find entertaining when successful entrepreneurs go, that person's really, successful investors, this is a little bit the traditional thing, that person's really arrogant. And you're like, actually, in fact, arrogant people who are really hard driving may be irritating at a dinner party, but very successful, right?
That's awesome. Look, we're going to shift to a question from Athena Karp. We can put her on stage. Sheila, Athena, you had a question about Silicon Valley and its future.
Ta-da!
Hear me?
Yes, now, yes, good.
Oh, great. Well, thanks for joining, and really appreciate the wisdom shared so far. It's been really fresh and interesting content. I think one of the questions I have representing typically the Tel Aviv ecosystem is, and especially with COVID, maybe making marketing and sales in certain elements less material than having very strong sound tech and or healthcare tech, AI technologies that can pivot much easier than others. So wondering if you guys feel we've hit the peak in Silicon Valley, and will there be different ecosystems, or what will the attributes of emerging ecosystems be in your mind?
Chamath, you want to go first or want me to?
Go ahead, please.
Right. So I think that the answer is both. I think that we've been over the last 20 years, we've heard a lot of, peak Silicon Valley, this housing crisis, peak Silicon Valley, that, lots of capital, too much capital, chewing things around, immigration difficulties. And actually, in fact, I think Silicon Valley will continue in strength, even with the kind of COVID and the kind of the fact that there's a bunch of movement out. I think it's just the same things that lead to that density of urbanization, anything in headquarters, the cities, the Silicon Valley, I think will still be there post-vaccine, et cetera. Now, the great news is I think that we've already seen, even pre-COVID, other ecosystems flourishing. I think it gives them more of a sense. One of the things that we've been doing at Greylock, we've actually already made multiple investments this year in places outside of Silicon Valley because it's pretty easy because you're doing it all through Zoom, et cetera. And so I think so I think the short answer will be both.
And Chamath, just quickly, are you long or short in the Valley over the next 10 years?
Yeah, I actually think the coronavirus pandemic has been the salvation of Silicon Valley for exactly what Reid just said, which is that it's forced people to break away from this whole idea that, all of life's, goodness exists between San Francisco and Palo Alto, not even Mountain View. And that's just kind of nutty and just kind of reductionist and lazy thinking. And so the fact that you're forced to now go abroad is good. I think, like I said, and I don't mean to be too nostalgic, but it's like, I think the best of Silicon Valley is really a mindset where you're celebrating failure, you're celebrating heterogeneity, not homogeneity. You're finding ways to cooperate because you don't feel like you are competing over scarce resources. I really felt like the last few years that wasn't the case. And so I think now is a good way to just have the pendulum swing back to what it was like.
Yeah.
So Athena, we have another question. Thank you for the question, Athena. Sure. Appreciate it. Sander Daniels, do you want to come up, ask about SPACs?
Yeah. Hey, Chamath and Reid, thanks for being here. My name is Sander Daniels. I'm one of the founders at Thumbtack. My question and asking for a friend is
the most upvoted question, Sander. Congratulations, 13 votes. Go for it.
Awesome. It's about SPACs. So, do you think SPACs are an enduring alternative to companies going public, or do you think they're a point-in-time trend that's only popular until direct listings with simultaneous fundraising is permitted on the New York Stock Exchange and NASDAQ?
I think that I'm going to be really blunt. I think your friend that is asking that question is well-intentioned, but is not really thinking from first principles. Neither of the people that voted that thought that question was good. It's kind of like any instrument. You could take a pencil and a piece of paper and write, The Great American Tragedy, or you could write a Dr. Seuss book. You could write some really incredible tome, or you could just write, chicken scratches. So the question is, what is the goal? I think that the goal is you want to align yourself with partners who can help you thrive for the duration of how long you intend to build a company. And going public is sort of a point in what should be a multi-decade plan if you really want to try to build something enormously valuable. And inasmuch, I think there's a big problem today in the public markets and the private markets, which is that there's just not a good translation layer for what your plans are. So, for example, I'm sure, or maybe you guys don't know this, but if you go public in a traditional IPO, you can't present a forecast for your company. Now, think about that. When you raise capital in the private markets, you actually show the future. Because what are people buying? They're buying the future. Now, you can only imagine the mindset when all of your presenting is the past. And there are all these tight guardrails. I saw that Todd McKinnon, maybe the CEO of Okta, he tweeted on Twitter, like, how is Chamath allowed to say these things? If I had said these things, I would have had the SEC up my ass. Yeah, no shit, Sherlock. That's the whole point of why this whole process is broken. If you spend all your time looking in the past, you can't describe the future. Now, in the case of Todd and Okta, it's a beautiful business, but it still took a little while for people to really realize what it was. And if you could have skipped all of that confusion in the middle, skipped all the volatility in the middle, and just got to the punchline and had people that were there to support you, it would have been better. You could have raised money better at cheaper rates faster. You could have consolidated market quicker. And now it's not, it wouldn't have been Okta plus Ping plus 9 other people. Maybe it would have been Okta and the valuation could have been 3 times bigger. So it's not to take away from what Todd has done. It's to sort of give you guys an insight to the fact that if you're really trying to have a winner take most or winner take all outcome, speed is important and the public markets can really slow you down. So the thing with SPACs it's a super fast time to market. You have an exact price up front that you decide to underwrite at that point, just like a private round. You can raise as much or as little money around it that you want. And the most important thing is, if you have a good partner, you can explain the vision of the plan for the next 5 to 10 years. And that gets into the water table. And once you do that, that gives you the chance for people to actually want to own this business for a decade. And in the publics, I actually think you could see people owning things for a decade because it is liquid, So that's my view. I just think I do think it's here to stay. I think that direct listings are kind of interesting. I did one with Slack. I think it's kind of like a little bit of a long walk from a short pier, to be quite honest. I think people care about the navel-gazing technicalities of it, but I think SPACs are just much simpler and more straightforward.
Reid, do you want to go for a hot take on SPACs, and we'll go to the next question?
Yeah, so Chamath's been doing them longer. Actually, +1 to the things he said. Although I do like Dr. Seuss, so I think that's a potentially good outcome. What I would say is the other thing, in addition to what Chamath said, and so I think they are here to stay. It's a new vehicle. Is it also gives you another chunk that's kind of at adding VC capabilities to these companies, because it gives you a chance for a kind of a concentrated ownership position and help and kind of network going on. So I think that's another thing that's advantageous to the SPAC process.
Can I give you an example? Like, look, let's take Airbnb, right? They're in the middle of a process, so we won't talk about it. But let me put it to you this way: in a traditional IPO process for Airbnb, I'm willing to bet dollars to donuts that what happens is it will get comped to Booking.com, and the minute you do that, they are going to trade on room nights. Now, you can take all the grand complexity and vision and drive that team has, which has built an incredible company, and it'll get reduced to one bullshit metric. And that is what the traditional process will do. Now, take that same company and put it through, let's just say, Reid and Pincus were the guys that did it. The conversation is completely different. They can talk about what they want to talk about, experiences, the long value of like how you're creating all of these interesting patterns. Like it's just completely different. And you can't do that in a direct listing either.
Awesome. Sander, thanks for the question. Dan Turan, we'll bring you on stage. Why don't you introduce yourself? And we're going to shift gears and talk about the tactics a little bit more of angel investing. And your question on check size was interesting. Go for it, Dan.
Great. Yeah. Hey, so this is a little bit more of I'm Dan. I founded a company called Managed by Q and then was on the exec team at WeWork tragically for a hot minute and left in October. Yeah, my question is a little bit more tactical. I think there's a bunch of folks in this group that have recently had some liquidity and are starting to do angel investing sort of for the first time or are raising rolling funds or whatever. I'm curious, like tactically, how do you think about check sizes at the early stage when you're really just trying to start to build a portfolio and get a feel for investing? I think both Mike had asked a question around stage as well. Just how do you think about sort of starting out to build a portfolio as an angel or seed investor?
Well, a little bit like what Chamath was saying earlier, I would say that make sure you're thinking portfolio. I mean, if you have deep conviction in one particular thing, then fine, kind of back up the truck. But back, when Chamath and I were both doing angel investing, Chamath still is apparently, it's kind of like make sure you have a portfolio. So it's kind of like whatever that check size is over, like if you say, I have X dollars, then make sure it's like a 20th or, that kind of thing as part of doing it with relatively selective doing it. Now, the other thing I would add to angel investors, I think this is still true even with the, kind of challenges in current VC, is the best way you can predict, are you on track, is what does the next financing round look like? Did a smart person lead that financing round, whether or not the smart person was a smart VC, et cetera. And that's a little bit of how to condition like which things you should be doing, because frequently you won't really have good metrics. You're making the earlier kind of judgments that Ben prompted me on about people and a back of the envelope number. But that's how I would look at it.
I think that portfolio construction is really something that's somewhat of a lost art. You mentioned a comment in here, which is that on what planet does Silicon Valley celebrate heterogeneity? My point is, I agree with you. I don't think it has over the last 5 or 6 years. There's been too much copycatting. But my point is that wasn't the case, meaning the surface area was a lot different 10 or 15 years ago. You'd have a company and you wouldn't have 9 competitors behind it. So you had a lot of room to play around and find your niche. And, there was, as a result, there was a lot of really interesting, non-obvious innovation. How we go back to that is, I think, again, in the earliest stages, I'm the most hopeful. And if you really take to heart what portfolio construction means, you can make that happen. So if I was starting out angel investing, I would take this quantum of money. Let's just say I had $1 million that I was willing to allocate. I would think about that as, kind of 20 companies. I would make the same quantum of capital, because I'm telling you, the a priori ability to size is impossible. Right? And so you might as well just make 20, 50K checks. And again, at some point in success, you'll get to this place where, now you can start to be super risk on and size. But that's going to be many years in the future. And you should do that once you know what you're doing. Yeah. And then you can mortgage the house and sell the things and the blah, blah, blah. And then you can make the multi-million-dollar bet. But I would start with take $1 million. Okay, if that's the number, it's 20 checks at 50K. And then I would try to sort of not be overlapping. So meaning you can create a heterogeneous portfolio. And the reason is because that's how you will identify where the alpha is.
Yeah.
Right? Having 7 food delivery businesses in a portfolio of early stage investments is fucking dumb. You wouldn't do that. Right?
Yeah.
Awesome. Thanks, Dan, for the question. Appreciate it. Is it different topic, Chamath? You've called social media businesses that hook us and addict us immoral on some level. Should the angels in this call with a moral compass not invest in startups that employ some of the growth hacking techniques that you helped develop back in the day?
No, I think I kind of view it like folks on this call, and Reid and I back in the day, we're like farmers, and all of a sudden, we find these ingredients and we sell these ingredients. And so, ammonia, there's nothing wrong with ammonia. There's nothing wrong with tar. When you first use those things to make a cigarette, there's also nothing wrong with that. It's the point when you realize that cigarettes cause cancer, that's when you start to become immoral. And so, I don't know, I kind of think I don't think you should judge the tool. I don't think you should judge the instrument. I think that tools and instruments evolve, and then morals and a moral attitude around things evolve. And that's where you do have to have courage. I took a lot of flack because the whole commentary was, hey, hold on, you made so much money at Facebook and how dare you comment? And I'm like, okay, but I never was trying to become this fucking rich. And I've always kind of said what I believe because I like to go to bed with a clean conscience. So take the fucking money away. I'd rather tell the truth. And so I do think that there is a point where once you know, you have to make your own moral judgment. By the way, it can also be completely okay. But you just have to be able to own the decision and not judge other people for it. So that's my...
Got it. Okay, awesome. Michael Magano, you want to come on and ask your question?
Sure.
About diversification across stage. Go for it.
Hey guys, I'm Mike. I'm one of the founders of Anchor, now at Spotify. Thanks for doing this. Question that's sort of related to Dan's line of questions, the previous question. For early stage angels, people that are new to angel investing, obviously, most often we're doing early stage. How important do you feel like it is to stay focused on early stage, or would you recommend de-risking by diversifying into later stage if you can get the access? I'm doing mostly seed, but every once in a while I see an A or a C or something like that.
It's the same risk. It's just more money, which is crazy.
Yeah, I wouldn't say, yeah, I wouldn't go stage risk. I mean, some portfolio management's a good idea, but it's not like, oh, look, I'm de-risking or portfolio managing because I'm doing later stage. That's essentially, Chamath and I would have the same point of view there. It's active decisioning, and then as you put more capital in, a little bit like what Chamath was saying earlier, as you put more capital in, then you have to think more about it, and you have to have a higher probability of being right.
Right. That makes sense. Cool. Simple question, simple answer. Thank you, guys.
We're waiting for the next person to go into the green desk question, but Reid, quickly, Turner Novak asks, do you agree with many folks' predictions that LinkedIn will be unbundled? It's the meme on Twitter that never refuses. Like every month, people come out and start attacking LinkedIn, saying it's ready to be unbundled. There are going to be all these vertical competitors. What's your hot take?
Well, I haven't seen it yet. Obviously, there's times where you get stuff that's in depth enough of what you're doing, like for example, GitHub or something else that says that's a different, distinct area from LinkedIn. There's a value in the generality, given that it isn't that, for example, the classic one that usually people talk about is doctors. Like doctors don't just talk to doctors, and doctors aren't the only referral to other doctors for patients and other kinds of things. And so there may still be that thing there, but the general thing is also very useful broadly. But it's not. Like it depends on depth and configuration of market and so forth, and I'm certainly not. It's not a religious point of view.
Sean, do you want to come on stage and ask your question about Peter Thiel?
Hi, Chamath. Hi, Reid. I'm the founder and CEO of Placement.com. I'm curious if either of you subscribe to Peter's views on technological stagnation. If yes, I'd love just a small there, and if no, which sectors lead you to hold a more optimistic view than he does?
Well, I'll just go first. I mean, because I argue with Peter a lot. He's like, oh, we didn't get our flying cars, although maybe we're about to, and da 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 da. And actually, I think the broad answer is the digital realm, artificial intelligence, everything else. So while some areas have been much slower, these areas of acceleration apply to all these others. That doesn't mean that we shouldn't also do, and I think this is one of the things that Chamath has been doing a good job of beating the drum on and investing in, is like hard tech and other kinds of things as well, and make sure we get there. But I think that's part of it. Like the one exchange that I saw that I thought was really interesting is Peter saying stagnation, and then Stephen Johnson said, by not having faster planes. And Stephen Johnson said, well, that's because you think that what people most care about is the speed of the plane versus safety and getting everywhere. And if you actually look at like the evolution of the plane industry, what it was really going to is safety and getting everywhere. Now I think we're about to see speed too, because I think the supersonic planes are, Boom and others are actually going to start delivering in useful ways. But that's kind of a breadth of it. Chamath, I don't know if you had anything.
Yeah, do you have a hot take, Chamath? Otherwise, we can.
I just think technology is inherently deflationary, and so I think we confuse stagnation and deflation because it rears itself in the same thing, which is that. We give more for less, so people get lazy.
Okay, thanks, Sean. Thanks for the question. Next question, I'll ask it because Sheila hasn't gotten to the green room yet. How do both of you think about your legacy? What are you trying to, at this stage of your life, both of you have made a ton of money, had a ton of success, ton of impact on the world. When you think about the next 20 years of your life, what are you looking to accomplish?
Oh, the small question for the last. Chamath, do you want to go first? Or you want me to?
Well, and maybe Chamath, you can go first because you've reflected publicly about like how much reflection you've been engaged in these last few years, and like how you've evolved your worldview to some extent based on that.
I have a very specific goal, which is I think that I can compound over the next 20 years, sort of more than $100 billion or so, and I want to apply all of it to climate change. And there's one thing that I think that I would like to sort of know that I burned all the money on, which is just some form of practical, efficient carbon sequestration. I think that would be an incredible thing to give to my kids. That's really, honestly, like I spend a lot of time investing. To me, it's feedstock. It helps me refine my risk-taking ability. But I feel like I'm prepping for a decision in 30 years where it's going to be all in on one thing. And it's that. I would really like to do that.
Well, so I can give an answer that gives an interesting contrast, because I've been actually doing more of a kind of a venture portfolio approach. So I have been doing some stuff like with, part of my hard tech investing in fission and fusion is partially in the climate change arena, but also kind of like, how do you get good entrepreneurial ecosystems? How do you help, kind of like get the next generation of kind of education and, kind of other kinds of things. So it's kind of, I'm taking more of a venture approach across a number of things versus the lunar moon bet. The closest to the lunar moon bet I've gotten so far is the Stanford Human-Centered AI Institute, with a bunch of kind of risk grants to try to make those the catalyst in AI technology much better across all the different industry.
And Chamath, just before we go to the final question, just on climate change, what's like for people who want to learn more and engage, and obviously it's top of mind for all of us in the West Coast these last few weeks, what's one book, resource, organization, person who you've learned the most from with respect to climate change?
In fact, that's honestly, Ben, I couldn't give you a great answer. It's just all over the place. The people I've learned from the most has been on Twitter. I asked folks to just send me, some ideas and some write-ups. I got 1,000 of them within 2 weeks. And they're all 7 pages. There's just fucking 7,000 pages. So I'm like, I'm like 1,000 pages in, but I feel like I've learned more from that than the internet. We all know what the solution is. Just that we haven't pushed the boundaries of science to really be able to figure it out yet. And I think that that's just going to require a lot of energetic people and a lot of money. I'm a former, but I provide a lot.
That's awesome. JD Ross, want to bring you up. We'll end on a sort of oddly tactical, hyper in the weeds question, but such is the nature of the passage of time here. There's been some chat about seed stage pricing and Series A pricing and risk. You want to just recap your view and question there, and if we have a sec, Reid and Chamath can react.
Yeah, absolutely. JD, I co-founded a small company called Open Door. It seems like seed stage pricing is getting more expensive on a risk return basis right now than A and B stage. Curious if you guys agree, disagree, and how you see that evolving over time.
Well, I guess what I would say is I think that there's this kind of, because so many people are focused on technology as part of the future, I think there's inflation of pricing across the whole thing, and so it becomes one of the things you have to pay attention to at all ends of the stack. And so I'm not sure that it's seed versus A and B as much as capital going into tech means that all of the pricing is inflating.
Yeah, I really agree with Reid. I think a great idea. By the way, I just want to say the quality of the people on this fucking thing is just like it's outrageous, Ben. So congratulations and thank you for including me. But you guys should be, your individual fund. If there's a way for you to like weave together and partner, you guys will compete with Sequoia and Benchmark to do Series A's as well. I mean, holy shit! Like it's really incredible. Just occurred to me.
Well, on that fantastic note, JD, thanks for the question. Chamath and Reid, thanks so much for joining.